Welcome in, guys. Get comfortable. We'll start the stream up here pretty soon. Let me know if the sound is good, the volume. Nacho, what's up? Hey, Marius. We'll give folks a few minutes to get in and then we'll start chatting. Hello, everyone. See some familiar names here. What's up, Gavin? What's up, Georgie? Tony? America's DIY sweetheart. Sovereign individual. Gavin. Hey, Caleb. What's up, dude? What's up, Evan? Mod. Sorry if I mispronounce your name. Gavin. BCB's a nice guy, blockchain backer. He's cool. Hung out with him recently. Capital B, the best letter has entered the chat. And then capital F says, I would argue that point. Incredible. Yeah, so we're just waiting for folks to kind of trickle in here. Give people a couple of minutes to notice the link is up. This replay will be saved on the channel, so if you're not watching this live or you can't stay for the entire thing, then you will be able to watch it back. Have no fear. I haven't done one of these in a while. You know, one thing I wanted to get, and I always forget between the live streams, but I'm thinking about it now. I really want to get some music, you know, to just go in the background while we're kind of getting ready for the stream. You're just kind of sitting here listening to dead air. So I need to work on that for next time. That's something I always forget. I haven't been doing these live streams as regularly as I want to. I keep telling myself that it's a good idea to have like a regular cadence of them, but I haven't figured out what that looks like. I don't know if I should do them every week. Sometimes that feels like a little excessive. So haven't really decided. Maybe twice a month, something like that. We'll have to see. Uh, but usually, a bunch of you guys show up for them, so maybe it is something that we should do more regularly instead of just kind of surprising you with it. What's up, everybody? Joe. What's up from Barcelona? How's it going? All right. Been rolling here for a couple of minutes. Let's go ahead and fire up an intro. Hopefully, the sound of the music is comparable volume to my voice. Hello, hello. Welcome back, everyone, to Alpha Beta Soup. I'm TXMC, and we're now live on YouTube. Thanks, everyone, for being here. Appreciate the tip, Reflected Digital. That's very kind and generous of you. Well, let's take a look around the market. I'll talk a little bit about some of the things I'm looking at. And then, of course, we'll get to some of your questions. I'll probably stream for about an hour. Usually they're between an hour and a half. We will stay consistent in that regard. And we'll just kind of see where this takes us. I've been trying to challenge my general bearishness lately because I have been feeling bearish. And, you know, we've gotten some upside here on Bitcoin that's gotten some people pretty excited. I have a trend line drawn here, but the funny thing with trend lines is it really kind of depends on what scale you use as to whether or not they're relevant at a point in time. So I don't really make too much of trend lines, but we are above the 200 week, which is good to see. You know, we were kind of stuck in this little channel here for a while. And what I was watching the other day was to see us break out above this, find support on either the 200 week or this line right here, and then maybe we can move higher. Don't know exactly how high it can go. My base case is still that this is a bear market rally. There's not been very much evidence to suggest to me that the economy is ready to improve and move on and start seeing sustained price appreciation across markets. We're just not in that kind of environment. So my base case about the economy hasn't changed much at all. But it's certainly possible that within a greater bearish macro view, there can be periods of upside. That's always possible. And maybe we're going to get some of that here. This is some pretty good strength to see off the lows, and equities look pretty strong as well. They've been rallying in a similar fashion. And in fact, if I look at it, let me look at it on the S&P specifically. Let me pull up a different chart. The interesting thing with the S&P was it had gapped above. Let me pull it up here. Yeah, so we had, I don't know why my line moved. We had this gap here on the S&P from the day that we got the 8.6% CPI print, and we had come back up and tried to get over it, but we had been rejected here in late June. And I thought, well, maybe that's because the market's expecting worse CPI. Well, we did get worse CPI down here at a local low, but it's been up since then. And we're now broken above this gap. This gap here was pretty violent, actually. Like it's pretty rare to see the S&P do a double gap down that straddles a weekend. This was like a Thursday to Friday to Monday gap down. You don't normally see this on the S&P, so that was pretty surprising. Usually that kind of a violent move is contained within the same week, oftentimes. But now we're back above this and we're trying to gap fill. So who knows exactly how high this goes. The bottom of the gap is 4,017 on the S&P. We're still trying to get above 4,000. I'm not huge on price targets. I'm just kind of playing with what I see here on the chart, talking through it with you guys. This kind of price action doesn't really change anything about my biases, about the things that I think that the market is due to experience. And it can go up pretty high. Bear market rallies can be pretty violent. They can go very much higher than people anticipate them to. And let me throw a fib on here. Let's look at a couple of things. Where could it go? That's a good question. I don't know that a full fib is the way to look at this. Maybe we do a fib from here. I mean, it's really hard to say. Could this get up to 30K? Yeah, it certainly could. It certainly could get up to this level here if we have some sustained strength. But without sustained improvement, substantial improvements to what's going on economically, it's hard to really know like how much strength this has, how long it can be sustained before people try to take profit in a very testy environment. It's really hard to say, but there are some like bullish things that we could look at besides being back above the 200 week. There are some bullish things that could challenge my general bearishness. And a couple of those kind of relate to these pullbacks. So if I throw a fib on here, and if any of you guys watch Blockchain Backer, I think he was looking at this the other day. I can't really remember. But regardless, if you throw an upside down fib here on the pullback, we pretty much caught support perfectly at the 786. And for price to go lower than this level here, based on Fibonacci retracements, there's really not any more support down below here from this perspective. So it's pretty sweet to see that it caught right here on top of, let me take my lines off, right here on top of this 786 retracement. That is kind of bullish, I guess you could say, in the sense that this is about as low as you would expect to see it come. I mean, we came down here and we kind of rolled along the 618 for a long time. We're now battling to get back over the 702. That is good. You'd want to see that if this was actually going to form a bottom here, that's a great place for it. We're below the realized price. We're below the 200-week moving average. And then we caught support right here at a 786 Fibonacci retracement. And now we're kind of, it looks like trying to form a bottom and get back over the 200-week. It's certainly compelling to look at. But what gives me pause, what makes me hesitant to say that's the bottom, no way we go any lower, is because I still expect there are more shoes to drop economically for the broader markets, for unemployment, and for earnings. And if those things unfold, it's reasonable to expect another leg down in markets. And I would imagine that Bitcoin would go along with that because everything is tightly correlated right now. So that's been influencing my general perspective. Obviously, I'm open to being wrong. I'm not married to my viewpoints. I try not to get too entrenched in a particular view because as soon as that happens, you usually find yourself on the wrong side. But needless to say, there are still things unfolding that are not good for the economy. Uh, Initial jobless claims set a new high, a new local high, all the way back to November, and they've been climbing since March. These are people filing for unemployment insurance. This value has been rising. And if you go back in history, I did a little look back. It's hard to tell because of this warped jump as a result of COVID. But I was looking back through here, and most of the time, when you get sustained lifts in jobless claims, it usually leads to greater unemployment and oftentimes happens right before a recession. So that's one pattern that isn't really playing in the favor of the bullishness we talked about. What else do we got? Yeah, here the S&P global PMIs came out today. It's for the United States, and it's a composite PMI between services and manufacturing, and it's now in contractionary territory. I'll zoom in on my chart a little bit here so you can see it better. Let me see if I can get a drawing tool up here. Boom, perfect. You can see right here we're in contractionary territory. First time we were in contraction since 2020. This doesn't happen very often. And when it goes below this 50 median bound right here, that is a sign that the economy is in a contraction. This is based on a survey of business owners. So it's kind of their perception of what's going on in their corner of the industry, and they aggregate it together. There are a lot of different versions of the PMI. There's the one that ISM puts out. They're the like inventors of the PMI. Each of the Federal Reserves, several of them, I don't know if all of them do it, but many of them have their own regional PMI for their part of the country. And then there's some other services like S&P Global here that put out a different one. So it's good to look at a bunch of them. I'll show you a couple of others here in a moment. But basically, anticipation for the next few months is getting worse from the people who are running businesses. And that's not really a great sign for the economy. If we go look over here, this is kind of a busy screen. Let's look at new orders. So I said that some of the Feds, they have their own surveys, right? They have their own business outlook surveys that are really similar to the PMIs. Well, the Philly Fed one came out yesterday. That's one of the ones that people really watch. And the new orders are up here on the top, and future new orders are at the bottom. And they're both in contractionary territory, new orders more so than future new orders. But when you look at both of these, just kind of in historical context, it looks like shit. You know, it's extremely negative, particularly here on the outlook for the future, for the next few months, future new orders. This is the lowest value it's been since 1979, guys. That is not suggestive of economic health. I mean, it's obvious that the economy is in a bad spot right now. But when we look forward, when you're talking to business owners as they look forward over the next couple of quarters, their confidence is extremely low. That's going to affect the way they run their businesses, and perception in a lot of cases manifests to reality. So I take these with some weight. And you know, when you look at just this is the activity index. We were looking at new orders specifically, which is one of several facets that they put together and make this diffusion index with. They have like new orders, unfilled orders, employment, and a couple of other things. The total index of all the questions that they ask business owners is also extremely low. It's down here, lowest value since 1979, 1980, since basically right here. So there's a lot to be concerned about. And when I see things like this, it suggests to me that even though we can draw some pretty lines right here about a bottom being formed on Bitcoin, we could probably do something similar on the Dow Jones, because seeing how it here is trying to catch itself on its 200 week, same thing for the S&P. It hasn't really broken below its 200 week. Maybe we've got some support here, right? And granted, there's some room to be moved down to this, but still, maybe we've got some curling action. But then, I go and I look at what people are in the actual real economy are saying about their business health and their expectations over the next few months, and it's very negative. It's extremely negative. So I think we still have another shoe to drop. And if you guys saw my last video, we talked about earnings as it relates to the S&P. And we still haven't seen earnings really drop in any measurable way. Shiller PE ratio. Let's look up the Shiller PE. This is price to earnings, and it's over a 10-year period, and it's smoothed. But if you look at where it is historically elevated. This goes all the way back to the 1800s. And, the only times that it's been higher than where it is now is in the recent bubble and in the tech bubble. That's the only times when the PE ratio of the S&P 500, seen by this way, by the Shiller PE, has been higher. We still have extremely elevated valuations, and earnings writ large, have not actually come down to match with the other aspects of the economy that are in contraction. When you look back in the past through periods of inflationary spikes that we've had in the 1940s, in the 1970s, all of those manifested weaker corporate earnings and in many cases higher unemployment. But we haven't been seeing that yet. Valuations still remain really high. And when you look at unemployment has been flat since March. You can see it over here. It's been flat at 3.6%. It hasn't risen at all. Now, this is a chart I posted on Twitter a while back, and it compares the S&P to unemployment. And what I was looking at was I was trying to determine, where does the market bottom in relation to recessions and in relation to what unemployment is doing? So I drew a bunch of lines on here. These red lines are where the market has bottomed. The blue lines are the peak of unemployment for that cycle. And I counted the days in between them. There's the average gap between the bottom of the market and the peak of unemployment is 8 months. 7.9 months, 236 days, if you want to be specific. And in every instance, going back to the middle 50s, back to 1953, every single time the market bottomed first, unemployment peaked second, and it was always around a recession. The difference in what we're seeing now, if we're going to call what the market has experienced recently a bottom, if we're going to say that this right here is a bottom, one difference is that unemployment has not moved. So in all of these other instances, going back to the 50s, like I described, every single time that the market had reached its low, unemployment had begun to rise from its recent low, and it had risen at least 20 basis points, which is 0.2% for unemployment. Had risen at least that much from its low. Most times it had risen much more than that. But the most conservative move was actually back here in 1953, and it had risen only 0.2%. All other times the market had bottomed, unemployment had risen considerably more, in some cases more than a full percentage point. Well, we haven't seen a single move in unemployment yet, even though, as we just talked about, we're seeing a rise in initial jobless claims. This is happening, but the unemployment rate is not really moving in the same way. So what that suggests to me, because this pattern has been so consistent throughout the last 70 years, it suggests to me that perhaps calling bottom here is a little too early, that there may be a couple more things that need to unfold. Perhaps we need to see earnings valuations reset, or earnings reset a little more swiftly. Perhaps that leads to some more job loss and it starts to raise unemployment a little bit. I don't really know exactly what that looks like, but I would imagine that if we start to see those things unfold, equities are going to come down. And then by the nature of their correlation, I would think that Bitcoin would come down. So that's kind of a framework that I've been working in. Vinny says my volume is low. Can I get some response in the chat if you guys think my volume is not high enough? I can turn it up. Just want to check with you guys. But basically, that's what I'm looking at. We see some bottoming formations. There's suggestions that maybe we've found some support here. But when I look at some of these other historical patterns around recessions, we haven't seen all of the steps play out just yet. We haven't seen earnings come down. We haven't seen unemployment rise. And those things almost assuredly will happen if we get a confirmed recession. Now GDP, second quarter GDP, some people said it's low. Okay. Maybe that's a little bit better. So second quarter GDP comes out next week. We're going to find out if it's negative. There's a high probability that it is. If we look at Atlanta Fed GDP now, let's go see what this stupid thing looks like. Look at this, guys. Look at their expectations for GDP for quarter two. This is Atlanta Fed. We're looking at minus 1.5%. What did they say it is? Yeah, minus 1.6% Q2 GDP. This shows an economy in serious decline. This value has been declining since May. It has been adjusted lower and lower and lower. And the reason that this is important to look at is because this calculation is done automatically by an algorithm that is taking all of the inputs to GDP in real time and calculating what it thinks GDP will be. Barely audible. I have people telling me they can hear me loud and clear, and then I have folks saying that they can't hear me at all. So I'm not really sure where the truth is in there. I hope that you guys can hear me. It's saying that I'm speaking rather loudly into my OBS studio. How does negative GDP backtest? Well, I mean, 2 quarters of negative GDP is the technical definition of a recession. Now, the National Board of Economic Research, NBER, that's the group that actually calls recessions for the United States. They use a series of indicators. They use unemployment. They use, a few other measures of economic activity. And when they see a bunch of them contracting, then they call a recession. What we may get is, because unemployment has remained stubborn, as we were just looking at, because it's kind of stuck here at 3.6%, it's possible that even though we get negative GDP, real GDP in quarter two, which would be 2 consecutive quarters of it, basically all of 2022 has been negative real GDP so far, but because we haven't seen unemployment rising, because they still believe we have a strong labor market, they may not call a recession, because usually recessions see higher unemployment. So that might be a disconnect where you have the market anticipating that we are in a recession. You have other countries thinking that we're in a recession because they go by they go by 2 quarters of GDP, but the NBER might remain stubborn and they may not call it until later. So I don't really know if that's going to happen or not, but that's certainly something I've got in my mind. So that's kind of what I'm looking at here. I did post a study the other day that I thought it would be interesting to kind of talk about with you guys. So I posted this tweet. The Congressional Budget Office is an office that they put out projections for the United States budget into the future, and they have a bunch of different studies, and they try to be a neutral analysis group, and they try to put out these projections. What we're looking at here is their projection for the U.S. budget going over the next 30 years. And there's a couple of different data points on here. So the dark blue line, the main line here, is the deficit of the U.S. government. It's their net spending. You can see here in the late 90s, there was a surplus where it bounces above zero, That was a period where we actually took in more revenue than we spent as a country. But the predominant trend is one of deficits. And you can see the deficit has been growing here in recent years. This dotted line is present day. So the deficit has been widening. It widens in periods of economic weakness as the government needs to spend, to stimulate, to uphold the economy, etc. Deficits widen. Well, there's a couple of other aspects to this, and one of them relates to net interest expense. I've talked about this on my videos. I've been making tweets about this. This is the cost to maintain the public debt. The U.S. debt is the world reserve currency, treasuries, and they all have an interest rate. They have an inherent expectation of yield, and that debt must be paid on an ongoing basis. That interest expense must be paid on an ongoing basis, lest the U.S. default on its obligations and we see a much more severe economic crisis. So what it's showing here is a growing cost of debt into the future. So this green bar, this set of green bars here, is the rest of government spending, not including the debt costs, right? So what I just described to you, net interest expense, you can call that debt costs. That's the simple way to describe it. The green bars is all the rest of the net government spending. Entitlements, Medicaid, Medicare, Social Security, defense spending, everything is in the rest of these green bars, the net spending. The reason I'm bringing this up is because right around here, right around the year 2027, the Congressional Budget Office anticipates that the cost to maintain the debt, purely to ensure the debt stays in good standing and that we do not default, that cost will exceed the entirety of the remainder of government deficits, which means that the amount of money we spend to maintain the debt will be more than the rest of our deficit combined, our net deficit. And you can really see that here. It starts in 2027. The red bars get bigger than the green bars, and then they just keep getting bigger. And over the next 30 years, this is expected to double as a percentage of our GDP. That is a significant cost. It puts a constraint on the plans of the Fed to continue tightening as long as necessary to slay the inflation dragon, which I doubt that they'll be able to meaningfully do. And it also really emphasizes the tight situation, the tricky spot that the federal government is in, because there comes a point where there simply is not enough money coming in to maintain their obligations. When you consider that we have an aging population that is living longer, that are entering retirement in large swaths. We can look at some of that data together. I had a video about it about a month ago. The fact that we have a growing retiree population who has an increasing amount of need for entitlement pays, right? They're reliant on Social Security. Many of them have Medicaid. Those are obligations that must be paid. The cost of those is continuing to rise in the future. The defense budget is continuing to rise in the future, and the debt costs are continuing to rise. So the government reaches a point, and it will continue to reach these points over and over again, where they're forced to decide, do we pay for entitlements and defense? Do we default on our debt, or do we print money to pay our obligations? And my base case is that they will print. They always choose to print because the alternative is austerity. And there is zero political or societal appetite for long-term austerity measures at this point of where we are as an economy and as a society. There's zero appetite for it. So all they will do, because of political expediency, they will monetize the debt. They will print money to pay their obligations into the future. And when we reach that point, it's basically checkmate, as Lynn Alden would say. And there's almost no way to escape it gracefully. I don't know exactly whether or not this swift expansion of debt costs will play out exactly this way. You can see this projection is very smooth, whereas the reality is much more choppy. So it might not play out exactly like this. But the general trend and the suggestion of it is one that has me wide-eyed. I wouldn't necessarily say concerned, because this is a pattern that fiat goes through again and again and again. But it's the reality that the U.S. is in now. And as the issuer of world reserve currency, it's something that I think everyone should at least have some awareness of. I'm quieter than all the other YouTube channels you watch. I don't know how to make my audio much louder without printing red bars on my OBS studio over here. So I will look into that when I'm not streaming. I promise I will try to check it out. First time viewer, brilliant content, should have more subs. Thank you, Michael. My channel has only been around for about a year. Have we even been a year, guys? No, I think it'll be a year, maybe in early September. Maybe we're not quite to a year yet. Here's another look at the same chart, and you can see this point right here where the red breaks below the green. That's the point where net interest expense is a deeper deficit than the remainder of government spending. You can see it right there. Do I think taxes will be insane in the future? I don't really know, Evan. I haven't thought about that. And that's something, I like to do some research before I give an opinion. I don't know what that means for the tax costs of regular people. There's only so far that you can really push that. And I think that even if they were to try to increase taxes on everyday people, it wouldn't fill in the deficit. And what should be concerning to all nations is that when you have a deficit as deep as what the United States has, history says that nations in that position default. It's not a good history. The U.S. has 125% debt to GDP, which I can show you over here. Here we are. Here is our debt to GDP. It's 125%. Look at the way it's been rising in recent years. Here's the great financial crisis right here. Debt to GDP soared up to 100% in the middle 2000s, 2010, 2013. And then it took another huge leap here in 2020. Now we're hanging out around 125%. There's only a few other nations that have more debt to GDP than us, and not a single one of them is a good example. We're talking Italy, Japan, Greece, Argentina, Venezuela. Those people have more debt to GDP than we do. That's not a good example because we're the world issuer of reserve. We're the issuer of the world reserve currency. So we've got 125% debt to GDP. We also have 10% or so deficits to GDP. And when you look back through like a 200-year period, there's a study from Hirschman Capital about this. If you look back through the last 200 years at countries that had that exact combination of 10% or greater deficits to GDP, 130%, which we had here, debt to GDP, every single one of those nations has defaulted within 2 years except for Japan. They're the one outlier. And those defaults take the form of either rampant inflation, which destroys savings, or strict default, just outright not paying interest expense, not paying their obligations. So those are the two outcomes. It's a 90% hit rate if you don't count Japan, 95% hit rate. And the main reason the U.S. has not had that same fate is because of demand for dollars, because so much world trade is denominated in USD, because there's so much dollar-denominated debt that must be serviced. It creates an ever-present demand for dollars. And then as we are contracting the money supply as a result of QT and raising interest rates, raising the cost of capital, those things put a squeeze on the dollar. So we see dollar resilience, and that's in a way helping to prevent outright, hyperinflation or collapse of the currency, because those things happen when people reject the use of the currency. So sustained demand really allows the U.S. to push this bubble further and further and further. And It's hard to know when it ends, but the suggestion is that when it does, it will be violent. And I don't believe that what we're experiencing right now is the true end of the bubble in the sense of the long-term debt cycle, of the fourth turning culmination. Like I suspect they can kick this can once or twice more. It can always go on longer than you anticipate. So that's just something to kind of keep in mind. We are at a place where cabin pressure usually reaches its apex. But simply because of demand for dollars, we have been able to sustain it. But as you look around the world, as you see what happened in the showdown because of Russia's invasion of Ukraine, and then the West choosing to strip Russia of most of its FX reserves, that literally changes the calculus for all nations that are holding reserves in central banks around the world. It changes the chessboard. And now countries like India and many others are starting to wonder, where can we keep our wealth? Where can we store our reserves? In what format and in what location, in such a way that it can't be taken away from us by an ally that turns into a foe? What does it take for the U.S. to label a country a bad actor? Certainly Russia deserves it for invading Ukraine, but we've considered India a bad actor before. We've done the same thing to France, and these are our allies. These have happened in the past. And so I think there's, when you see that kind of event happen, like what happened in March, what the West did to Russia's reserves, I think that that's a significant moment. It upends dollar dominance and it's impenetrable dominance. And I think that it starts a chain reaction that over the next decade or possibly couple of decades, we see a further weakening of dollar dominance as people diversify. When I say people, I really mean sovereigns. We see sovereigns diversify. Maybe they go to more commodity-based, reserves, whatever it is that they do. There's a lot of theories about what that looks like, but it's undeniable that the calculus has changed, and it's possible that the dominance the dollar enjoyed for so long, which allowed us to run such significant deficits because we needed to supply the world with dollars, that might begin to change a bit over the next 10, 15 years. I don't know, but it's certainly a possibility. Sometimes I make you feel sleepy. Maybe I should start screaming a little bit. Well, I invest in homesteading before this cocaine operation ends. I do think real estate is probably something worthwhile to own. The housing market is certainly quite elevated, but actual land, real estate, is hard to come by. They're not making any more of it. I personally am trying to acquire some land. I think that's a good idea because, when you look back through the history of money, when you look at societies that have engaged in fiat money creation, we've been doing this since ancient China. You can go back like 2,000 years and see this same history playing out. And the thing about it is they go through these cycles and they've gone through them over and over again. And it's hard for people nowadays to really conceptualize this because it happens across generations. It's rare that it occurs in a single lifetime. And some of this history is so old that many people alive today don't even understand. We've been through this before. It looked different, but we've been through much the same before at different places in time. One of those is in ancient China. So the Sung Dynasty, which you could go read about, there's some different research papers about the Sung Dynasty and paper money. And they engaged in fiat, just like we are now. They had unbacked paper money. It created a lot of leverage in the system, a lot of unbacked wealth, and they failed to invest in productive means, and they were conquered by a weaker foe, by a less powerful foe who, took them in a moment of weakness. And when their economy collapsed, they rejected fiat, and they returned to hard assets again. They returned to commodity-based money. They started using copper coins again, and that was good for a time. They remained in that way for a few different cycles of leadership. But a couple hundred years later, a new leader came in and reinstalled the use of paper money. And they went through the exact same cycle again. The same dynasty, the same cycle. And this has played out again and again and again. I just use ancient China as an example because it's such a clean example and it was so long ago. But what happens, you have paper money, you have unbacked money, people in charge of the money supply inflate it into collapse. Society returns to hard assets and commodity-based money for a time, and then they return back to fiat later. But that period of time where hard assets are used again, I think we will experience that in our lifetimes. And what I believe is different now from all previous instances that this occurred is that we now have Bitcoin. So we have a digital, borderless, unconfiscatable commodity asset, a bearer asset that people can put their wealth into if they're trying to escape a dying fiat currency. And that choice was not available to all prior generations. They only had gold, they had silks, they had copper, in some cases cash. Those are the only options available to them. So I think that opens the door for Bitcoin to be a huge benefactor over during my lifetime. If what I think is going to play out does play out, if we see the melting of various currencies, the consolidation of money, then something like Bitcoin stands to benefit tremendously. Do I see China overtaking US as the global leader? No, not really. Their economy was powered for 20 years by globalization. The entire world chose to outsource cheap labor from China and have them make everything. And as a result, China ran intense deficits. They built a bunch of cities that nobody lives in. And now they're actually in economic straits. They've been going through their own recession before we started tightening. They were already experiencing it. You could see some of it last year when they had the Evergrande problem. They've been going through their own tightening. They have food shortages. They have an aging population that is expected to shrink over the next 50 years. China also doesn't have an open economy. You cannot become a world reserve currency if you don't have an open economy to the rest of the world. If people can't trust their capital in your shores. So I don't think that they're really positioned to supersede the US. I think what's more likely is that we don't have a single dominant country, 10, 15 years from now, but rather we have a multipolar world that's, regional alliances. And that's probably okay. It's just a different world from what our grandparents lived in. We look through the chat here. Oh yeah, I should mention, if you enjoy this content, please give my video a thumbs up and subscribe to my channel. I greatly appreciate all of your support. It allows me to keep doing this research, keep talking to you about the things I'm finding. And I really hope that one day my channel is large enough that I can make it my full-time job. But I need your help to do that, and I appreciate anyone who is willing to give me a sub. Thank you so much. And thanks for being here. If you have questions for me, feel free to throw them in the chat. I know I kind of bounce around a lot. I talk fast. So, feel free to interrupt me if there's something I didn't explain very well. I'm going to look around through here. There was a couple of other things I wanted to talk about, and I can't think of what they are here. Oh yeah. So we can look at a couple of these things. So I've been trying to look at the housing market, and I'm definitely not an expert on the housing market. I've been asked more recently my opinions on it, but I don't necessarily feel qualified to project what I think the housing market's going to do. But there's some things that I think are interesting. And one of those is this chart here, which shows mortgage originations by credit score going all the way back to 1999. Now, this chart is amazing. One thing I really like about it is that you can see the subprime boom in the 2000s. You can see that here. These are people with credit scores below 620. And this was the subprime boom. This is what led to the subprime crisis and the collapse of, the entire mortgage industry in the middle 2000s. But there's something quite different about this housing market that we're in now. And you can probably see just by the colors of the bars being different. And the main one is that in the last few years, the vast majority of mortgages in dollar terms have been taken up by people with a credit score of 760 or higher. Those are people at the top echelons of credit scores, people that have the maximum credit worthiness. And it's interesting because in dollar terms, they now have more mortgages than the rest of the groups combined. That hasn't been true at any point in this data. Maybe a couple of random years here, their originations were bigger than some of these lower bars, but this is a considerable trend. If I show you in a line chart, same data as over here, you can really see the difference. Look how much higher these people with 760 credit scores are. So there's something going on that's different with the housing market here. We don't have a bunch of risky loans out there. We don't have a bunch of mortgages with people who have no business owning homes of those values. Now, valuations are sky high. They're ridiculous. They deserve to come down. But relative to the market, the quality of creditors or the quality of debtors in the mortgage market is vastly different. They're considerably higher level of credit worthiness, which suggests to me that if we have a pullback in housing, if that market cools off considerably, it won't have the same exact outcome that we saw back here in the 2000s, just based on this perspective of it. You ever considered creating a paid service? I've thought about making a newsletter, and I may follow through with that because people ask me to see my charts more often. So I've thought about doing that, and maybe I'll get around to that this year. When we get inflation figures starting to decrease, do you think that will signal that the market has already bottomed? I think it's possible, DB. It kind of depends on the order of events. So, earlier on the stream here, I described some things that I think haven't played out yet. One of those is a significant fall in corporate earnings and a rise in unemployment. Those two things typically happen at the bottom of a market, particularly one that is screaming that we are going to go into a recession. Like, there are so many different leading indicators saying that we're going into a recession, but earnings and unemployment haven't responded yet. So if we start to see over the next couple of months inflation prints coming down while labor remains very strong, it may make the Fed think that their policies are working. Right? We could debate about whether or not the labor market is strong. I would venture to guess that it is not as strong as they think it is, because I think unemployment is being warped by changing demographics. There are fewer people who want to work. So as a result, businesses are still expecting the same kind of labor participation, and those two things are at major odds with each other. But if we see we just got the highest inflation print we've ever had, right? So in 40 years, and the Fed has said they need to see multiple months of it coming down. So that's the first thing we need to establish, is that they are expecting a multi-month series of lower prints. They don't want to see 1 month of a lower print, because what they're thinking about is what happened last summer. So let me pull up CPI. Let's go look at it here together. Wow. All right. So if we go look at CPI together here, this goes back to last year. This right here is what they're afraid of. See this blue line? This was last summer. And during that period of time, inflation, it had jumped up from like 3 up to 5, and then it flatlined for a bit here. And this was during the time when Powell was still calling it transitory. And then all of a sudden it took off again. And really here, this print right here was the one that really scared people. These November, December prints, especially December when it got to 7%. But it really started taking off. And Powell has said in a couple of different interviews, one of them was the FOMC press conference, he said that they do not want to be fooled by this again. They do not want to be fooled by sorry guys. They don't want to be fooled by this again. So, if inflation just printed a 9.1, If it prints like an 8 and it starts kind of doing this for a couple of months, they're going to be thinking that we're in one of these. They want to see multiple months of inflation coming down. Unless we get that, they're probably going to stick close to their plans. But one thing that I think is working against them is if we look at the Fed funds rate. So the Fed funds rate is the terminal rate that they raise every time they have an FOMC meeting. And when you look at the Fed funds rate, that's here in this red line, and you compare it to the 2-year Treasury yield, which I will put in a black line here. Every time in the past that they have hiked the Fed funds rate and it has reached the 2-year Treasury yield, that has been the end of hikes for that cycle. This pattern has been playing out for 40 years. Let me get blue here. It happened right 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 here. 5 different instances of hiking cycles where when the Fed funds rate met the 2-year Treasury yield, that was the end of hikes for that cycle. Well, the 2-year Treasury yield is currently at 2.995. It's having trouble getting above and staying above 3%. And the Fed's target rate is up here. They think that they're going to get to 3.5%. They've even said 3.8%, which is up here. Yet the 2-year Treasury is right here, and it has curled significantly. I'm looking at this on a weekly chart. If you see it on a daily chart, you can really see it's struggling, right? It's struggling to get above 3%, 3.2%. So what I think will happen, if we get another 75 basis points, we're going to be up here. Maybe the 2-year is still hanging out right here. And then what's going to happen? What are they going to do? Are they going to raise another 75 basis points? Then we're going to literally be at the 2-year Treasury. That'll put the Fed funds at 2.75%. 2-year Treasury will be right above it. And if they come together and kiss like lovers, well, if you look back through history, every time that's been the end of the cycle. So I don't know if they're actually going to get to the end of their plans. They may reach a point where the market says, no, guys. No. You can't flip the curve at the front. You can't do that. So I don't know what the market will do. I don't know how it will react. When this happened back here, in 2018, 2019, there was Powell pivoted with the swiftness. Even though we looked like we were heading into a recession, but the economy wasn't totally collapsing. But the Fed funds rate got out ahead of the 2-year. There was some stress in the corporate bond market, and he pivoted. Maybe he does the same thing again. I don't know, and maybe I didn't answer your question. I'm kind of rambling a little bit here, but there's just so many facets to this. There's so many different moving parts. Anyone who thinks that they know what's going to happen is absolutely blowing smoke. Are rate hikes the only way to combat inflation? Well, Daniel, the only way really to combat inflation at this stage is a recession, because it is embedded into the economy at this point. Like the reason it is there is because of structural supply constraints. People think the inflation is because of the money printing. It isn't so much because of that. It's really because we shut the global economy down that was running on just-in-time logistics back in 2020, and it's never recovered. It has never recovered. It's been exacerbated by Xi Jinping's zero COVID policy, and they shut down Shanghai and all the ports every time somebody gets a sniffle. It's been encouraged by Russia invading Ukraine, 2 of the world's leading exporters now at war with each other. They export energy and food to the rest of the world. Those things are making it harder for inflation to come down, but it's really as a result of the messed up supply chains all around the world that are simply just not getting better. And because of that, it's completely out of the purview of the Federal Reserve. There's almost nothing that they can do about it except engineer a recession which forces people to stop spending money. That's literally the only thing they can do. That's what they've essentially been trying to engineer. As we've been studying on my channel going back the last couple of months, we've really been looking at what Jerome Powell has been saying, at his talk about bringing asset prices down, how they can't do anything about supply. All they can do is adjust demand. And when he sees that there are a bunch of job openings twice as many job openings as people seeking work. He thinks that the economy is very strong and that it has room for him to tighten and tighten and tighten and try to attack inflation by making people feel more poor. That sounds harsh, but that's literally what they're doing. They're trying to make people feel less wealthy, less financially secure, so that they spend less money. And as a result, they think inflation will abate as a result of those things. I don't think that's true. They could engineer a recession, and then because they have to stimulate to help support people who can't pay to buy food and gas and shelter with elevated costs, they're just going to embed the inflation in the economy and we'll be stuck with it for longer. What's my strategy to position myself well through the recession? Well, this will be my first real recession as a market participant. Back in 2008 and 2009, I wasn't investing like I am now. I probably am going to stay mostly in cash and Bitcoin like I am now. I am long the long bond. None of this is financial advice. I'm not qualified to give you guys advice. Please do your own research. But if you're asking me what I personally am doing, I'm mostly just in cash and Bitcoin. The one thing I did do was I went long the long bond, which is EDV. Some people use TLT, which is just another ticker, almost the same thing. And it's TLT is specifically the 20-year Treasury. EDV is the 20 and 30-year Treasury. And the reason I did that is partially because I think bond yields have topped. I could end up being wrong. I could end up being vastly wrong. But I went long some EDV down here around 98. And I'm going to ride it back up here to probably 140 or higher. I'm going to see where it goes. This seemed like a good spot to get in because when you look at treasuries, they seem like they peaked. They've set a higher high. Let me put this on a monthly so it's a little easier to see. They've set a higher high after a 40-year trend of lower highs. And, you've got these strong wicks here and they just look like they can't get any higher. It looks like the bond market is really struggling to price in the rate target that the Fed thinks they can get to. So as a result, my current thesis is that bond yields have peaked. So that's one play that I have going during this, but mostly I'm going to sit in cash. I'm going to continue acquiring Bitcoin at the lows because I have my long-term thesis on that. And when I think that the Fed is pivoting in the way that the market wants them to, I'll probably allocate a little more heavily to BTC at that point because I would expect it to respond. I also have some gold, but I'm certainly not a gold expert. But I do have some gold, and I might try to acquire some gold at that point too. Because when the Fed actually pivots, not just pauses, but when they actually return to QE and injecting liquidity into the markets, which they will have to do at some point, I expect that gold and Bitcoin will respond well to that because that is monetary debasement, and that is the fuel for hard assets. Why didn't I sell my Bitcoin at Christmas like a sensible person would have? Because I didn't want to sell my Bitcoin. I sold other stuff. I sold other things in January. I had some stocks. I was trying to trade a couple of like random shit coins, but I don't ever talk about them on my channel because I don't want to lead people astray and have them investing in poor things. So I don't really mention that stuff on my channel very much. Sucker. Okay. You reckon this clown is broke? All right, buddy. I don't really know why you've come into my channel being so hostile, but we'll just go ahead and get rid of you. See you later, bro. So, a lot of people got this bubble wrong. And there were a lot of people that didn't really know what was going to happen in November and December. And I'll be one of the first people to admit that. And I've been very open about that. I misread Bitcoin back at that point of the year. I was making tweets in October and November about on-chain. And, we were seeing some on-chain metrics that just looked crazy quiet. Like they just looked shockingly quiet. Like, let me pull up Glassnode here and I'll show you guys what I'm talking about. Wait, no, I can't pull it up here. Let me pull it up on here. Coindays destroyed. Maybe I can just make a chart for you real quick. And I'll show you what I'm talking about. There there were some things that looked bearish, but I wasn't actually reading them that way. I was reading them as something bullish, as some kind of a new pattern. And that was some of my immaturity as it relates to Bitcoin, right? Because I'm not perfect. I'm just a guy on the internet. You guys listen to me because maybe you find my charts interesting or something. But this is what I was looking at back in at the end of the year last year. So I'll put the price chart on here just so you can see where this is. Okay. So as we were going up to the second all-time high, back here, July, August, September, October, right here, here's the price chart. The amount of coin destruction, the amount of volume of spending on chain was super quiet, right? We had seen this big run up during the bull run. This is coins spending on chain. These are coins of older duration, hodlers who are paying themselves for taking on risk and wading through the bear. People taking profits and spending on chain. It elevated swiftly and then it started to decline. And even as we went up and set new highs over here, this value stayed flat. And I remember tweeting back in October, it was around this time of the market, right here in the middle when we were almost back to the all-time high. I tweeted, wow, this is the quietest run up to an all-time high in the history of Bitcoin. It's never been this quiet on chain at the all-time high. And I took that at the time to suggest that maybe we were seeing more hodler dominance. You know, I still wasn't 100% sure that the bubble was ending, and I didn't fully appreciate the effects of inflation, the growing specter of inflation. Obviously, we have learned much since then, but it really didn't take long for me to get bearish, and I really flipped bearish probably in early December, right around the time that we had this big liquidation cascade. Here it was right around December 4th. Let me zoom in some more. Yeah, this move right here was right around December 4th. We had a huge liquidation cascade, and there was like a 10K red candle. And that was really when I got bearish, and I've been bearish ever since. So yeah, I am not perfect. There are a lot of people who got things wrong, but what I feel is different about me from others is I am willing to admit that I was wrong, and I'm not trying to convince you guys to buy things at the top of markets. That's not my priority. My priority is to talk to you about my observations. You guys can make your own decisions. So we've been going for about an hour here. I just got an alert. Let's go check out the VIX. Got an alert. Well, I just got an alert on PRK1. What's that? PRK1. Pork futures. Oh no, guys. Pork futures are breaking out. They're breaking out above April resistance. We're going to new all-time highs on pork futures, guys. I set alerts for all kinds of weird stuff on my TradingView, and I recommend you guys do the same thing if you have a TradingView account, or if maybe you use some other software. It doesn't matter. But I'll go look. Sometimes I'll just sit here and I'll go through 100 charts, and I'll just set alerts for pivot areas, and I'll move on. And then later on, I'll get alerts for something. I couldn't even tell you when I set this. It could have been all the way back here. Who even knows? But at some point, I set an alert for pork futures. And so here we are. Let's go see the VIX. I got an alert about the VIX this morning. Let's see what it's doing. Let's take the 200 week off. That doesn't mean anything for the VIX. All right. You know, this is pretty interesting. The VIX has remained really subdued. And I've seen a lot of people talking about they expect a blowout in the VIX because that's usually what happens, right? Usually the market bottom comes in when the VIX is blowing out over 40. But it hasn't been over 40 since October of 2020. It's been 38 was the highest that it's ever been, and that was in January, right on like the dawn of war. So it's been really odd to look at the VIX, and when you look at the volatility of the VIX itself, it's way down here at the lows. It's at like multi-year lows. And you know, I don't have access to looking at put call volumes on different tickers and on the S&P, but I see some people tweet those things out, and it really looks like a lot of the market is grossly hedged to the downside. and it's almost becoming an asymmetry. How many people are hedged to the downside? Now, if we start moving up, it can create some reflexivity in there, especially with like dealer positioning. But I don't really know what's going to happen with the VIX here. I don't know if we're going to see some blowout in volatility, but with everything going on in the economy, I think that whenever it does happen, it's going to be pretty violent because it's remained really subdued here for almost this entire year. I mean, just look how small these candles are, these weekly candles are on the VIX, as we're sitting at some of the most rocky economic times that anyone alive has seen. The VIX bodies on these weekly candles are tiny. So this is definitely an anomalous period for volatility in the S&P. Jeff Snyder has interesting takes. Yeah, Marquis, he does. I find him to be a really interesting source of alpha. Yeah, the episode of What Bitcoin Did with Jeff Snyder was a great listen. I listened to it the other day when I was driving back from hanging out with Blockchain Backer. I listened to it in my car. Jeff is a really interesting researcher. He takes contrarian views. He thinks one of his views is that the Federal Reserve is not really a central bank. I'm not going to try to parrot all of his perspectives because I won't do them justice. But I do suggest any of you, if you're curious to just kind of hear some alternative takes on what the central bank does, what the Fed does, why we have inflation, what the market is likely doing, then I suggest you go check out the What Bitcoin Did episode with Jeff Snyder from like a week ago. It was really good listen. And Jeff speaks in not vagaries. Jeff has really esoteric knowledge and it can be hard to follow him, but I think Pete McCormack did a good job of trying to talk to him in layman's terms. So that was a really good interview. So I think we're probably going to wrap this up here in a few minutes. If you have any questions that I haven't answered, throw them in the chat. We'll get to them. Base case for how long the bear market lasts, maybe through Q3. Yeah, I think for sure. Marquis, something I was saying earlier, maybe you just got in here. I expect the earnings shoe to drop, and it hasn't yet. We were looking at the Schiller PE earlier together. It's still quite elevated. Unemployment hasn't moved at all. And just when you look at the history of the market, it usually doesn't bottom until unemployment has already started to soften and get worse. And we are seeing rising initial claims. It's been rising since March. It set a high compared to November, a local high. It suggests that we will see a softening of the labor market. But maybe this quarter is not the one. Maybe Q2's earnings were they weren't as bad as I thought they would be, but maybe Q3 is where we see it. And I think that's part of the thing that's so tricky for people right now, myself included, is the duration of all of this. People are expecting us to just collapse into the floor and for us to, really see who's swimming naked in a very short period of time. But I think the pain trade is going to be the duration of this whole thing and how long it really takes to play out. This could play out for the rest of the year. And the bear market could last well into next year. There's a significant chance that if the Fed returns to easy money policies at some point, without any of these structural issues around resource supply being addressed, that we could just be stuck with inflation into the future. And then it becomes a race of the clock. It becomes a race to provide enough dollars to people to stay ahead of sticky, elevated costs, which are also then being pushed up by wages, and it creates a spiral. And the Fed is desperately trying to avoid that. So they don't want to be forced to ease before inflation appears to be getting better. But when you look at the complete lack of oil capex, you can pull up things like, Permian drilled uncompleted wells. Here we go. Okay, I don't need to. Okay, well, I don't have access to Y charts, but you can see the chart in the background here. This is an example of oil capex, right? This is not getting better. This is the Permian region. It's one of the most productive areas in the United States for oil, and they are not putting money into the expansion of additional capacity for a lot of reasons, because they're being discouraged to do that. And that is a structural constraint on the supply of oil, which goes into literally everything in the economy. And so I don't believe that, even though we're seeing commodity prices coming down, I don't believe that that's just the end of the commodity cycle, because we haven't seen that expansion of production. There are still constraints there. And even if we create a recession, there is a floor on the demand for gasoline and for oil products, because there are not a lot of substitutes and because it is such a vital cog in the global economy. So there's a floor on demand that it can only go down so far. And I hope I'm explaining this well, but I really think that if they return to easing and they start returning stimulus because people can't afford to buy food and eggs, maybe we have reduced harvests later this year. None of that has really come to roost yet. We're still going off of food supplies from the last harvest. If those things come to roost later this year, we will have more inflation. I don't know that it will set higher than 9.1% CPI, but it could remain sticky and stubborn, and stimulating into that will just exacerbate the problems into the future. Best to be flexible and not fall in love with a single thesis. We can all be wrong, and being able to pivot and adjust your thinking is the best practice. I agree completely, Jason. Oil chart? Yeah, I'll pull up the oil chart for you since I've been talking about it so much. Here's a chart of oil. It's extremely volatile. Obviously, it's rare that it stays elevated, but it can. It can at times stay relatively elevated. It's stayed close to $90 or $100 a barrel for 5 years. So there's no guarantee that we have to come down here, down to the 50s and 60s again and just move on with our lives. Especially when you look at things like investment in capex in one of the most important regions in the country, and they are still seeing a reduction in uncompleted wells. This is the first stage of oil production. So they go out, they establish sites, they create drilled but uncompleted wells, and they have those available. And then as they need to produce, they go to each of those sites, set up the rigs, and they start producing. But they have to do that first stage. There was a long stretch of many years of expanded capacity, in many cases unprofitably by U.S. oil companies. But now they're experiencing profits. Their shareholders are demanding more fiscal responsibility for them. And they're being discouraged by the government to invest in capacity because they're being told that their industry is not important. It's not the future. So there's a lot of reasons that they're just simply not investing in more capacity, and our oil problems are not likely to go away anytime soon. When's the last time I bought BTC? Today. I buy Bitcoin every day. I have a DCA on Strike that I buy every day. That's just because I just chose to use them. I was using Coinbase Pro, but then they forced me to whitelist to my withdrawal addresses, and they're going to make me move back over to using Coinbase proper. And I hate Coinbase. I've just had them for years. I never recommend people use them. But I wanted to find a place that had lower fees. So I'm currently using Strike. I might switch to using Cash App or something else, maybe Swan Bitcoin. I haven't decided. I'm not recommending any service. But I have a daily DCA of Bitcoin, and then occasionally I make larger purchases depending on what's going on. But I increased the value of my DCA once price got below the realized price. I'll show you the realized price. I think I've got it. Here. Let's go find price support. Yeah. So once we got to the realized price, let me do the last 2 years. Here we are. Highlight selected items. Here's the realized price, 21,000. When we broke below it, I guess it was mid-June now, I increased the size of my DCA. And I'm going to leave it there. We're now back above the realized price, but I'm going to leave it there for a little bit longer, maybe while we're under 30K, and try to just scoop as much as I can, because we're at generational lows, guys. Whether this is the low or not, maybe price falls another 25%, 40%. I don't know. I'm prepared for that. I don't really mind. Bitcoin is not a trade for me. So that's why I didn't sell my Bitcoin in December. I just kept my stack and I waited for it to get cheaper so that I could buy some more. What time of day do I make my buys? I don't even know what time of day it is, Marquis. I think it's actually later in the day. It's just whatever time it happened to be when I set up the buy originally. I don't really pay attention to the time of day. I just make sure that it's consistent. We will have major food shortages coming in late fall. It's inevitable. I think it's true, Andy Walk. When you think about how Russia is a major supplier of ammonia and fertilizer, and that has been cut short, and then there's a lot of news reports about reduced harvest yields and expectation of harvests later this year. That stuff doesn't manifest until late September, October, November, when the harvest actually comes in. And then we find out how much food there is. So I think that there's still another inflationary spike in food, even for a place like the United States, which is much more food secure than other parts of the world. We could still very much experience that here. And I don't think that that's really being factored in by the market whatsoever. What if we get to a place later this year or early next year where there's just not a lot of meat on the shelves? There's not a lot of corn, just because there simply wasn't enough of it grown as a result of reduced fertilizers and reduced yields. So that's something I think about. I'm not an expert on that industry, and I haven't done enough research to do like a whole video about it. But it is something that is on my mind and I think is heavily discounted by the market. Just like I think the possibility that we may be stuck with inflation even if we get a recession. I don't believe that that is being factored in by the market. I think there's a lot of people in TradFi that are assuming that once we get a recession, inflation is done. People think that because we saw the 9.1% CPI print, and then we've got all these different commodities like, let me go look at futures. All these different commodities like oil, well, now I don't know any of these stupid abbreviations are. Corn, everything kind of looks like this now. So people are assuming inflation has been solved, but I don't necessarily know it is because of what we've been talking about, because of supply constraints, because of actual fundamental issues constricting how much of that resource is available. And some of that hasn't been manifested yet. Some of it takes months to play out. So that's why I'm really hesitant to try to call bottom, to try to say inflation has peaked. Maybe it has peaked in year over year terms. Maybe 9.1 is the highest year over year value we get, but it could stay elevated. It could stay elevated at 4, 5, 6, 7% for a long time. And that is still a positive rate of change. That is still an increasing price over what it was a year ago. And that can only be sustained for so long, particularly when you look at people's wages and you look at like average hourly earnings, right? That's here in yellow, but inflation is here in blue. It's outpacing people's actual money they're taking home. And so people basically since April of last year, have been experiencing negative wage growth. For an entire year, people have been taking a pay cut in real terms, despite the fact that nominal sales are continuing to set new highs. So there is a fundamental, severe weakness in the American consumer, and it cannot be sustained for very long before they just simply stop buying things, right? They cut their budgets down to the absolute requirements. And that is a reality that we could be facing at some point. Uncanny XL, what's up, homie? Glad to see you in the chat, my friend. Uncanny XL has a great TikTok. If you guys are horror fans, go check out UXL Horror on TikTok. My man posts daily videos and reviews. He's a big fan of horror and film in general, so highly recommend you check him out if you want to talk about something that has nothing to do with markets. All right. We've been going for an hour and 20 minutes. I'm going to wrap up here in the next 10 minutes. I'll continue answering questions in the chat, but in about 10 minutes from now, we'll call an end to the stream. Evan asks, do I think there will be universal income? Yes, I do. I do think that we are headed towards a universal basic income future. They're going to try that. They're going to try it when we get to CBDCs for sure if they haven't already tried to install it before then. And it's because of what we've been talking about, right? We're in a debt-based system that is reaching an apex of cabin pressure, right? We have a severe debt problem. The cost to maintain that debt continues to rise over time and take up more and more of our budget. Just last year, we paid more than half of our defense budget just to make sure our debt didn't default. We paid $380 billion last year, and it's going up. On a monthly basis, here in May, it was the highest monthly total that we've ever seen. So we're in a debt-based system that must continually expand, or it collapses as a result of its own leverage. The Fed will print to make up the difference. That they will be left with no alternative but to create money to pay their obligations. And when they do that, at a period of elevated costs and economic weakness, where people are finding it harder and harder to pay their bills, they will see, as a result of angry constituents and angry voters whose number one issue is inflation, they will be compelled to provide stimulus directly to people. They may try to, these are just my theories, obviously. I believe they may try to target that stimulus, whereas in 2020, it was kind of a kitchen sink approach, right? They were buying corporate bonds, they were buying treasuries, they had the PPP loan program, they sent money to fucking everybody 3 different times. And then they had, then we've had a few different other things. They had student loan forbearance, which ends at the end of August. People have to start paying their student loan payments again. We've had mortgage like eviction forbearance, like all of those things happening at once. But they may try something different next. They may try to target their stimulus. They may say people who make under a certain amount get XYZ dollars each month to put towards gasoline or to put towards food. They may try some kind of a food stamp program that's more widespread. They may, try to target the economy in those ways. All of those things are inflationary. All of those things are driven by politics. None of them will solve the problem, and all of them will exacerbate inflation. My OBS studio says that I just disconnected. Did you guys lose my stream for a moment, or have I been here the whole time? Let me know in the chat. I've never seen that message before. Just over in the right, it said OBS disconnected. So hopefully that wasn't the end of my stream. Okay, cool. Don't really know what that was about. It seemed like buffering for half a second. Okay, cool. My internet looks great, so I don't really know what happened there. But I think all those things are inflationary. I don't think any of those things will solve the problem. And when we get to that point, because it will create entrenched inflation, where wages are always trying to rise to entice people to come to work so that businesses can continue to make money, they will have to continually raise wages, which also puts upward pressure on inflation and creates a wage price spiral, which is the thing the Fed's trying to avoid. But they may not have any choice but to create one, because the alternative could be something in their minds much more severe. Because there is zero, literally zero, political appetite for austerity. None. They will paper over the problems with money, as they always have. And based on human history, that is the path that we are on. And at some point, I believe hard assets will have their day. That's why I allocate to Bitcoin. All right. I'm going to wrap it up, guys. My voice is getting a little scratchy. I need to go with the wife to Costco. Need to get some lunch in me. If you enjoyed this video, if you enjoyed this stream, please share it with your friends. Please subscribe to my channel and enable that little bell icon so you know when I put out new videos. And yeah, I really enjoy doing these. I've talked about doing them more regularly, like on a schedule, but I've been hesitant to do that because I haven't really been able to decide a cadence for it. But I really appreciate all of you being here and hanging out with me. We've got 160 people in here now. We've had 900 people come in and out of the stream over the last hour and a half. So thank you to everyone. This will be available on the channel to watch back afterwards. If you missed part of it, if you're just getting here now, or you had to leave earlier, this whole thing will be available to watch once YouTube gets done processing it. I know sometimes the things I talk about can sound really doomy. They can be scary, and I don't deny that. But there is a pattern to history. These things have played out for many millennia, for decades, for centuries, across different civilizations and societies. And the US is going through its own phase now. We're at a culmination where we have a brewing sovereign debt crisis. We have an everything asset bubble created by record stimulus. We are at the end of a long-term debt cycle, and we are also in the fourth turning, which is a culmination of societal transformation that occurs every 80 to 100 years, and it has been occurring for hundreds of years. All of these things are culminating now in the 21st century, in these last 10, 15 years, and in the upcoming 10 or 15 years. We're right in the middle of what I believe will be the most defining era of all of our collective lives, just the way that our grandparents were defined by the 30s and 40s. I think that we will be defined by the 2010s, 2020s, and 2030s. It will look different. It will be our own version of a transformation. But I do believe that afterwards we will experience abundance and prosperity, because that's the natural ebb and flow of cycles. And that is what follows a period of upheaval and transformation. So it is very stressful, but the way I manage, someone asked me earlier how I manage my stress. Keeping things in historical context helps manage my stress a lot, because the alternative is that my imagination runs and I start to think that this time is unlike any time before and that it's going to be an unmitigated disaster. That's just a negative place that I don't like to go to. So when I see that these things have played out over time throughout history and that society makes it through every time, I really don't worry too much about it, even though it will be tumultuous. It's just kind of the natural ebb and flow of money and society. Thank you, LaGuardia Tech, for being such a positive force in my channel. You are not welcome in future chats, so thank you very much. Everyone else, I really appreciate you being here. Thanks for your support, and we're going to wrap it up. Cheers, everybody.